So we'll continue, we'll start with the new standard, which is 110, which is a very important, always comes as a compulsory question to you. So we'll understand how this consolidation actually works. So before we move into consolidation, do you know how many countries are there in the world? 196. If we start plotting, okay, when I updated somewhere 188, somewhere I got, whatever, 196 countries, maybe Kailash is included or not included, we don't know. If by wealth wise, if we start plotting, who is the richest one? USA. Like this we start, no? Next we may add China, then we second Japan, third China. Okay, we may go there. So 55 countries, after 55 countries, no? You know, one person comes. He is Jeff Bezos. Again, old story. Now I don't know. Updated one, who is there in the first plot and all. That means, see, after 55 countries, one person comes whose wealth is more than any other country's 56th country. How much rich he must be, no? Then from their number of, that means literally he can go and buy one country. That much wealth he has got. Now, how do we get this picture? Then see, that gives us a different perspective, no, about that person. We know, Jeff Bezos is the richest person. But how rich he is, if that perspective we have to get, we have to look something. It's not just Amazon. We have to look into one consolidated picture. Because he is not rich only because of Amazon. He has rich investments in so many other places. So cumulatively, that makes him so rich. His brand is Amazon. But it's not just Amazon, he has investment. No? So this type of pictures, if we can get, we have to consolidate things. Then we get a better picture about the strength of a person, strength of a company, and all things, whatever hanky-panky things they do, no, it will go off, cleaned. Everything, because Enron, they did the fraud like this. Okay, they created a securitization. They created a special purpose entities, sold their debtors to them and got the money back. And those special purpose entities were not consolidated. That's why the accounting became stronger. Today's day, you cannot skip even unincorporated partnership also you have to consolidate. So you cannot do all these type of things after 2002, after Enron collapse, no? Because it was said that Enron even paid to the government officials to amend the accounting standards in USA. Possible? Anything can be possible. In India also, some companies approached ICAI to amend forex related provisions. We didn't result. They approached MCA. That's why there is one accounting standard para number 46A amendment, where there is one amendment happened in favor of one company, which we will discuss in Ind AS 21. Not Ind AS 21, Ind AS 101, because that impact we will see today during migration. See, these things do happen, students. That means, see, ultimately we issue the standards in a very neutral manner, because we don't keep in mind any companies there into picture. And they have to follow that. Otherwise, auditors are going to qualify. Investors are going to shout on them. How come they approach us to manipulate frame the standard as per their favor? No, it doesn't work that way. Then you should see how much independent we are, how much respect we get for our standards, because somebody has to recommend our standard. Government said, look, we will tell the standard to the companies to follow, but unless we come, the standards prescribed by ICAI should be followed, and they will not come. Leave it. That much of efforts, and we only have put, and nobody else can put that. When you know who is Alfred Nobel? If you come across this name, what comes to your mind? Nobel Prize. You know the beautiful story behind it, and he is connected with consolidation. Where is Alfred Nobel? Where is consolidation? Now, to understand a beautiful story about Alfred Nobel, see, he got one unique opportunity, okay, which generally people will not get. The opportunity goes like this. One day, he opened a newspaper and he saw, okay, he is the one who invented dynamite. You know that? He invented dynamite and he became extremely rich because of it. Dynamites, man, explosives, because they are used in the war and other things. Now, one day, his brother died. The newspaper confused that he died, and in the newspaper the heading came, the merchant of death is dead. And he was surprised to see that. Next day morning, actually his brother died, newspaper mistaken. Then he realized, Arey Baba, this is how people will remember me after I die. Then he decided, no, people should not remember me like this. That's why today when I say Alfred Nobel, you said Nobel Prize. See, we remember one person for something great thing he has done. Today Nobel Prize means country is going to celebrate. Oh, our scientists have got Nobel Award. Then he took all his money, whatever he earned by the death of people. He instituted one award, okay, 6 or 7 categories. One is the peace itself. Now, why I'm to give him a reference, because he established one company called the Noble Industries. And if we look back, 100 years back, they started consolidated financial statement in the 1922 for the first time. That means all what we are learning exactly 100 years back, these concepts were not there. It was fairly a very simple exercise. But eventually over 100 of years, it has become so powerful, so complicated, it has become a specialization in itself. So we don't have any thousands of years history for consolidated balance sheet. Just hardly 100 years back it started because of this guy, because of his company. Now, where is the life of consolidation hidden? I told you, no. Where is the life of Ind AS? Neck of Ind AS. Who is the neck of Ind AS? 109. Did you catch? Yes. So you have seen, no? Things will fall in your control. Now, where is the life or neck of this Ind AS 110? When I was small, I used to watch movies. Okay, there is one Mantravadi someone. He used to kidnap some princess. Then one prince will go to kill him. But you cannot kill him. Why? Because his life is in one parrot. You have come across that stories and all. Some movie story. So first this princess has to cross 7 seas and first catch hold of that parrot, kill that parrot, and then this person can be killed. So do you want to kill that parrot? So if you really want to kill this parrot or say this consolidated balance sheet, just catch other equity, finish, done. Consolidation is done. Going forward, don't tell me consolidated balance sheet didn't tally. I'll ask you, what is your journal entry? You missed your journal entries. That means you're not good. I'll say be strong in the journal entry, because if you are strong in journal entry, other equity you are going to catch. We have got only 2 steps here. Out of 2 steps, 1 step we already done, called calculation of goodwill. Done, 109, 103. In the second, in this, see, in the previous step, we were trying to focus on the goodwill. In this chapter, we are not going to focus on the goodwill, because goodwill calculation is fairly simple. They will not ask you deferred consideration. That many permutation combinations won't come. They will relatively a fair, simple calculation of goodwill. That is my starting point. But the next thing is I have to focus on other equity. But what is the concept behind other equity? In accounting, certain great equations have been gifted to us. One of the equation is asset is equal to liability plus owner's equity. You know this? Or can I say this asset minus liability is equal to owner's equity? Same, no? Or can I say net asset is equal to owner's equity? Or net asset is equal to equity plus other equity. So our equity share capital is a very simple thing, number of shares into face value. But the other equity and net assets is some equation we are going to talk about now. So the master equation will be, what is profit? How did this equity increased? In 1700, when the economists came, like Adam Smith and all, they gave the definition of profit. In fact, our accounting is a child of economics subject. They gave an equation. What is profit? Profit is nothing but change in the net assets. See, after this Luca Pacioli invented double entry principle, for quite long, for centuries, there was no concept of P&L only. What is the profit? Profit is nothing but net asset of the last year minus net asset of this year. This is what your economists also said. After recently 100 years back, we developed one statement. We started to give the breakup of that. That is called a P&L account. So this is what all David Ricardo, okay, Alfred Marshall and told. So finally, father of all equation in accounting is debit is equal to credit, okay, which is given by Luca Pesce. So now other equity I am going to talk based on this principle only with the journal entry, nothing else, okay. Now there's one concept of control. Always we used to talk about control there in joint control, business combination control, control over relevant activity. What is this concept of control? Control is equal to power over the investee plus variable return from the investee and power linkage between the power and the return. This is called a concept of control. To explain you, okay, when all these conditions are fulfilled, we call it a control. Okay, now we have to see who is controlling. Say for example, when somebody is driving the car, and first only I will tell you, this is not a driving school car. There is only one brake, one accelerator, one steering clutch. Now who is controlling? Wait, what do you mean by control here? First, do you have power over relevant activity? What is your relevant activity? Movement. And you want to do some stunt there, like you want to make the car like this, you want to run it to 200 km fast, you want to do jump over something. These are all the things of relevant activities which you can do only if you move. No? Only the car standing still you cannot do that. Now second, do you get a variable return? Yes. What is the variable return? Do you have the relevant activity? Answer is yes. Chalo. Let us talk about the, do you have the variable return? What is the return for you? Speed is the return? Huh? Sorry? Can I say thrill is the return for you? Thrill is the return. Arre, Baba, why on earth you will do this? You are not enjoying only. Will you do that jumping and all? You are doing it because you are getting one variable return called a thrill. If you don't do it, you will not get it. If you do it, you will get it. Now my question to you, the third question. You have got the power, you have got the return, but can you use your power to get this thrill? Now you need an evaluation. Imagine his wife is sitting next to him. Can you do that? Now who is controlling? Followed, no? That's why today's day, the control concept is different. You may see somebody driving there, like me. Now, I used to do that. I did that once. While going in the night, no, I switched off the headlight and started to move. Only once I did in my life. Thrill, no? Night. Me and my wife only. That is newly married. She came and told at home and all this thing. Afterwards, I never did that. Right. Plain, right. See, now point is, see, if you have to do it, you need to have absolute control over activities, whatever. But if somebody interferes, if somebody stops you from doing it, that means you don't control it. The movement or whatever things are controlled by somebody else. Understood? So this concept we will apply now in our this particular thing. So first we will learn about certain adjustments for out of this goodwill. It's like a drinking water for you. And I'm not going to do any working, okay? It's like a 1 + 1 is equal to how much? If I ask you this, you will note down? No. So we know now goodwill calculations. But as a refresher thing, we will do some elimination of unrealized profit. We have already done in Ind AS 28, but we will see how to do it on 100% level. And the NCA closing balance. Opening balance we have calculated in 103. How to calculate the closing balance? Then we'll start with the consolidation adjustments. We will do the chain holding, some 2 or 3 questions. This is the main, okay, heart. We'll spend considerable time here. Then subsequent change in NCI, that means again you may sell, you may buy. And the last is the loss of control, which is opposite of 103. In 103 you consolidated, in loss of control you deconsolidate. So rest everything is a very small aspect, very few questions. Chain holding is a brother of consolidation question. Is only one adjustment is there, only one adjustment. So you have to understand how to consolidate. Okay, so let us start with the theoretical part. First we will understand, and some theory questions are there. What we will do, we will do then and there itself, these theories. Yes, so we'll start with the theoretical part, 110. So first we will learn about certain basics, theoretical, some exemption from consolidation, what is power. Just now I told you an example of power, but we'll learn in their language only. Subsequent consolidation, I told you the hard, chain holding, subsequent change, loss of control. That's it. From the practical point of view, only this much. Now, consolidation standards, Ind AS 27 we have learned, 27. Ind AS 28 equity method, 103 is a business combination, 110 is the consolidation of subsidiary 100% and the joint arrangement. All this set makes you consolidation standards. This one book maybe probably. Now, before we have to discuss going into the concept, we have to discuss the concept of control and exemptions. Now, what is consolidated? This is the balance sheet of the group, which includes your all the assets, liability, equity, income and expenses as a single entity. But you include only parent and subsidiary. You may include your CFS, that associates also, but accounted as per Ind AS 28. Here you have to add two balance sheets of parent and the subsidiary together. So 110 doesn't speak about percentage holdings. And same concept of control is used in 103, but we didn't discuss in detail there. 110 entities required to consolidate when you get the control over the investee rather than mere percentage of holding, because even though holding 80% also, you may not be able to control them, and without holding anything you may be controlling that. Dual listed entities, did we discuss? Dual listed corporations, you didn't invest only, but you started to control another person. 60-40, no, A6 directors were appointed by the one entity, 4 by another. If it was equal control, you would have said joint control, joint arrangement. Now, what is control over investee? There should be all the three conditions should be fulfilled. You should have the power. Having power is not important. You should have exposure to variable return. That means in the form of equity, not in the form of preference. So that you take certain decisions, it will affect your returns. And more importantly, you should be in a position to use your power to get that money back to you. That is your ability to use the power to affect your returns. If all the three conditions fulfill, then we can say, yes, you have got a power and you are the one who is controlling that business. Now, power you may get by existing rights that give the current ability to direct the relevant activity. What do you mean by power? Power means directing the relevant activity. Now, how do you get this power? Generally, the rights will give you the power. Rights can come from the voting rights. Rights can come from appointing the key managerial person. You may not invest anything, but still you may be controlling, because one of the trust, no, you are the major trustee there. God knows in which form you are controlling. Rights to appoint another entity, that is to direct the relevant activity, remove other entity. Rights to direct the investee to enter or veto any transaction. Means I can make someone do it, not to do it, stop the production, continue the production, double the production. It doesn't matter how I get that rights. I may get it contractually, or I may get it by investing in equity. But I should do it. If I have not invested in equity, then if I get the right to control, then NCI is 100%. But I should consolidate. Their assets are my assets. But what is the NCI share? 100%. Goodwill comes only in fair valuation. If the NCI is valued fair value, goodwill comes into picture. If NCI is done based on proportionate asset, goodwill doesn't come into picture. Are you getting connected? Same thing we did in dual listed corporation, no, to give you an example. So it doesn't matter. You may be holding only 20%, but it need not be your associate. It may be your subsidiary. So evaluation doesn't go with the percentage of holding. Evaluation goes with the, are you controlling relevant activity, and do you have the variable returns there? Relevant activities can be like selling and purchasing goods, managing the assets, selling, acquiring assets, doing research and development, funding structure, capital decisions. You remember one of the place, the equity structure was jointly decided. That road, toll, construction and all. We said no, it is a joint decision, joint control. Why? Because funding, equity structure, capital structure was the main relevant activity. We could have stopped someone doing from something. So only substantive rights are covered and not the protective rights. That means somebody can stop me to protect themselves. What is this? We will see one question, then you will understand it better. Have we discussed this in 116 protective rights? 116 we discussed. Okay, 111 also we might have discussed. That is 116. 116 we discussed. Lease, where that we told no that lorry you cannot use after 8 o'clock. That is 116. That is called a protective. A licensed driver only you should use. That is a protective rights. That is not substantive rights. Anyhow, good. You recall, that is very important. Which standard? You will practice it. But it should strike to you whenever I give you this example, you should get the interconnection. Now, assessment of internal entities control. See, if you open the study material, so many examples, so many discussions. I will tell you the crux, because till now in exam it never came. Even though it come, you have to take a risk. Otherwise, you have to open the study material and read so many things. Now, what they said, look, today you might have created so many structures, complex structures, and some of the entities you will keep outside the structure. You will not consolidate it, like for example, Enron. So if you want to consolidate, how do you consolidate? Always start with the purpose of investing. Why somebody is established for the first time? You check that. Why a special purpose entity is established? What is the design? Is it a partnership firm? Is it a private company? Is it a limited company? Public company? You have to evaluate it. Like suppose like Enron is here. They have invested in one SPV. Now question comes, is this SPV to be consolidated with Enron? That's why there is one assessment of entities control. First you should check who is this SPV, how it was established. Is it a trust? Is it a society? Is it a partnership firm where your company is a partner? Because it could have been any structure. Second, what is the design? And first of all, why they established? What is the design of it? What is the legal structure? What all the relevant activities? What is that activity this will do so that it will earn an income there, cash flows? Now, this company's decision, how it is made? Is it done by the partners, or is it done by the board of directors, or it is done at the AGM? Whether Enron has the power to make such a decision, are they party to that decision? Are they directly the board of directors? The board of director here is the board of director here, or the board of director here is the board of director of one of the subsidiary. How complex, no? Why? Because see that's they have made it like this, Baba. Enron is exactly happened like this, I'm telling you. That's why all these rules came. We have become rich because somebody made this. Otherwise, these provisions would not have been there if everybody was Satya Harishchandra. Life would have been very simple. Accounting standard, same lookup resolution you will have followed. Why we want all these things? Now, whether Enron has got a variable return from this investing, and can they use it? If yes, irrespective of whatever it is, consolidate. If anywhere you get answer no, then leave it. Don't consolidate them. Understood? That's the way you have to analyze. Should I do consolidate or don't consolidate? Even though this should happen at the time of 103 also. We didn't discuss there because 110 they discussed all these things. And if your answer is yes, then 103 comes into picture. Then you prepare a consolidated balance sheet for the first time. Then 110 comes at the end of the first year. Do we have any exemption from preparing? First of all, who told me to prepare CFS? In India, section 129 of the Companies Act told me to prepare CFS if you have got associate or subsidiary, and associates includes your joint venture. A parent who controls more than one entity they said, not limited company, should prepare CFS. However, there are certain 3 exemptions given in Ind AS 110. Similarly, exemptions are given in Companies Act also. We will not bother about it. When you write an audit answer, write both. Companies Act, this exemption is there. Accounting standard, this exemptions are there. But almost similar. Who need not prepare? An employee benefit plan for which Ind AS 19 applies. Say for example, I will not explain much here because nothing much is there. As per Ind AS 19, if you have got a long-term PV/DBO obligation, did you create a plan asset? How did you create? This entity must have created one trust, and this must have handed over this money to the trust. and you call it plan asset. Now, should you consolidate these trust assets also with you? No, you take one plan asset, no, enough. That's the fair value of the plan assets. Don't line by line, their land, your land, their equity share investment, see, consolidation means your balance sheet is here, subsidiary balance sheet is here. It's called a line by line consolidation, like one by one you do the consolidation. Their assets you add with your assets. But in a trust, no. You already have got one asset sitting in your balance sheet representing that trust. It's called FV, fair value of the plan assets. Enough. Why you want to consolidate again? And again, they are not within your control. No, it's a trust, it's a separate entity there. You cannot use their money for your business. Once you are given out, one gone. That's why employee benefit plans don't consolidate. Investment entities need not consolidate if they evaluate FVTPL. We discussed it somewhere, we will discuss more now. And an intermediate parent if they fulfill 4 conditions. Okay, now first part is clear to you. Again, you are not going to come across anywhere, just for your academic interest, know that. Investment entity, now investment entities have got an exemption. Now, who is this investment entity? I will also claim I am an investment entity. Nice, no? MRPL is telling I am an investment entity. Just because you will claim I am an investment entity, will you become? No. Accounting standards say, Ind AS says, check whether certain conditions are there. 1. Did you obtain fund from the investor? See, because an MRPL, can it be an NBFC? Can be, no? MRPL can collect money from the general public in the name of like whatever corporate deposit, whatever in the different names. MRPL is running one business. See, that's why, what is the difference between MRPL business and NBFC different? That's why in NBFC, we have to apply 50-50 rule. Whether 50% of your assets and more are financial assets and more than 50% of your income is from financial assets, then it is an NBFC. So anybody in the front, you must have seen some people, and we also do the gossip. Business is there, only namesake. Behind every smuggling and every other activities are happening. Front, there is one proper business there. Back, different type of business. So MRPL can be involved in that. They are actually into NBFC, but name they are telling I am into crude oil. That's why there are certain tests involved. So first of all, you should have obtained a fund from investors for investment management services. MRPL also may collect money from the general public, but what purpose they will collect? They will collect to purchase crude oil. Why crude oil? To do their business. That's why MRPL is not an investment entity. Alternatively, MRPL may like L&T, Bajaj. When I say Bajaj, what comes to your mind? Scooter. Okay, but they have got one more thing called Bajaj Finance, which is an NBFC. At least they created 2 different companies. What if under the name of one company they had 2 business? Possible, no? People might be doing like that, no? That's why first check, did you obtain the funds from the investment for investment management, and do you commit yourself that you are investing solely for the return and you are going to measure all your investments at a fair value basis. If all these 3 conditions are fulfilled, yes, we will call you an investment entity. For example, mutual funds, pension funds, investment banks, NBFCs. Now, sometimes there may be a confusion. Then the standard says you consider additional test. We will get money. Did you get it from more than, whether it has got more than one investment? That also you have to test, because if it is difficult to determine, or it is not based on the above 3 conditions, then additional test you have to see. You have collected money from the public, but have you invested in only one company? Then what you are trying to do, you are trying to disguise like an investment entity, but in reality you are not an investment entity. It is just a structure created to avoid the consolidation. Is there more than one investor? Maybe I will nominate one investment entity, give money, that will invest there. I can create any structure, no? You see how deeply accounting standards go now. Whether investors are related parties, very intelligently they said, because generally in a mutual fund, the investors are not related, no? And whether ownership interest is in the form of equity, what the mutual fund will give? They'll give you the mutual units, which is in the form of equity investment. If all these 4 conditions fulfill, yes, then you can treat it like a not investment entity. So that's why if you want to claim an exemption that I am an investment entity, first, do you do investment management service? Your purpose is to invest and measure fair value. If answer is no, you are not an investment entity. Yes. Do you have got a typical characteristic like multiple investment, multiple investments, etc.? No, then you apply the judgment. If yes, yes, you are considered as an investment entity. And if you are an investment entity, yes, you can enjoy one exemption from preparing consolidation of your subsidiary. Why? Because your purpose of investment is not to control the relevant activity. Your purpose of investment, say you are invested 60% just to get the fair value appreciation. Then consolidation makes no sense. No? What makes sense is to show the investment as an investment in whoever it is at the fair value, rather than taking their land. Imagine, no, LIC's balance sheet. LIC has invested 60% in MRPL. LIC prepare one consolidated balance sheet where they are showing PP, this thing, what is that called, oil block. Somebody will wonder, now what LIC has to do with the oil block? Now they invested in MRPL with the purpose to get the return. For ONGC it makes sense. Showing oil block, broiler, this, that and all, no? It makes sense. Understood? Yes. Now, who is this intermediate parent? See, now, so many structures are created. We have already seen. A is there, E has invested in S has invested in S1, S1 has invested in S2. Like these structures are there. Now, everywhere, the moment you have got a subsidiary, you have to prepare a CFS. The moment you go for a CFS, you have to appoint an auditor. You have to appoint a people to do it. Cost. That's why, to avoid this compliance, they said, okay, I'll give you an exemption. Now, whether all our owners do not object, like if you are 100%, headache is not there, you have got only one, but you may have other NCIs. Are they okay that you don't prepare CFS? Because you are an intermediate parent, no, not a final parent. Are you okay? Are they okay? Answer is yes, sir. They are all okay that even though I don't prepare CFS, my owners don't want it. Okay. Have you listed? If you listed, even though your owners don't want, you have to present. Because let the other investors know there. No, sir, they are not listed. Do you want to list? No, I don't want to list. Okay. Does your ultimate parent prepare CFS? Yes, then you need not prepare. But if your ultimate parent is a human being, for whom Ind AS is not applicable, and then I will not give you exemption, you have to prepare. Understood the logic here? Theory questions may come, probability is very low, because consolidation they focus on the questions, not on the theory, but may come also. And more important, in exam, interview and all, they may ask you. So, before we proceed into consolidation of the subsidiary, yes, we will look into some theory questions on the control. Yes, sure. So first you need to tell me a very beautiful question which was sitting in the RTP of May 19, which never came. Angel adopted Ind AS from 2017. Before that they were following accounting standard. Okay. It has made the, see, understand the difference, because in accounting standard the moment more than 50% means consolidation. Here control is consolidation. It has made an investment in the equity share of pharma. So Angel's subsidiary is pharma. In the business of pharmaceutical, how much you made investment? You have made 21% as on 1st April 2017. So as per accounting standard, what you would have shown? Associate. Now there is one more company called a Little Angel, which must be 100% subsidiary of Angel. They have invested 24%. So together, you two together becomes 45%. Still you don't control it. As per accounting standard, you don't control it. Then there is a mutual fund, which is an investment entity, who have invested 3%, and balance 52% is invested by the general public. Okay. Now, none of the shareholders enter into any shareholder. That means balance 52% shareholders, no? They are like frogs. Nobody is related to no one. That means taking unanimous decision is a very difficult task. Little Angel is a 100% subsidiary of Angel, in which Angel, not 100%, 51%. So, Little Angel has to listen to Angel. If Angel tells, go and pharma pass this resolution, whoever represents little angel, no, they will go and nominate that only, because little angel is the son or daughter of angel. Wealth mutual fund is not a related party. That means wealth mutual fund will not listen to anyone. It is a totally independent investment company. Individual public shareholders are 17,455 numbers spread across India, and none of them has got more than 1%. That means even though somebody comes for the attending AGM, people may come because sweets will be there, breakfast or whatever, God knows, everything will be there. But they will not take any decisions there. They may irritate there, asking nonsense questions. But when it comes to the resolution time, passing on the resolution, they may not be able to influence anything. Now, all the commercial decisions of pharma are taken by the directors. Now, question comes, who is appointing director? Who are appointed by the simple majority vote of the shareholders in the AGM. Okay, in the AGM, we will put a resolution with a simple 51% majority. Whoever is present in that AGM, we will appoint the directors. And those directors will take the decisions related to pharma. Now, let us look into the AGM patterns of the past 3 years. Angel attended and voted all in favor of their resolution all the year. That means they are the regular customers. Little angel also are the regular customers. That means these two people are regularly attending all the AGMs. Wealth master also attending. Sometimes they will put in favor, sometimes they will put against. Sometimes they say no, this director should be appointed. Sometimes they say this should not be appointed. Now, individuals, 7% of the shareholders attend. Next year, 8% attended. In that 7% also, there was no unanimous consent. 50% voted in favor, 50% voted against. And same thing is happening. 6%, 7% people attend. Now, generally, who in this type of situation, who is in a position to appoint the board of directors? Majority. Who is the majority? Angel and little angel together. So, everything happens as per the instructions of angel there. They know that 52% we can never ever come together and pass single resolution telling we don't want angel directors, we want this director. Now, pharma has obtained a substantial long-term borrowing from the bank, and the loan is payable 20 years from now. As per that borrowing, they have to require the prior approval of the bank before payment of any dividend, buyback, issue of bonus shares. That means somebody is stopping you from certain things now. It's called a bank. They have given you a long-term loan, and they said, look, before you take any financial decisions, come and ask and take our permission. Now, recently, the board of directors pharma proposed a dividend of 5 rupees per share because maybe they wanted some money. So, they told who proposed? Pharma proposed means who? Angel wanted money. That's why they told pharma, you declare dividend because I want some money now. I don't want to take a loan. However, when this CFO for pharma approached bank, because one of the decision, the terms and condition of the loan, that before you declare any dividend, you didn't take our permission, they approached the bank for approval, but the bank rejected. They said, no, you don't have any liquidity. I am not going to permit you to declare dividend. Immediately, the directors of Angel, see, snake came out. The real person behind this dividend will come out now. The moment the bank rejected pharma's proposal, the real person who wanted this dividend, no, they came out now into the picture. They went to the bank and say, sir, please approve it. At least approve 2 rupees. Forget 5 rupees. But the bank categorically rejected, no, I am not going to permit anything. Now, under IGAP, Angel has classified pharma as its associate. 20 plus 21 plus whatever, 24. Now, CFO of Angel, you have to comment, is this classification correct when you transit to Ind AS? Nice question. Probability of this question coming is low, but conceptually beautiful question, a very practical and relevant question. Now tell me, who can, is that classification correct? They are following Ind AS 28 equity method, and they propose that they want to do it. Is pharma subsidiary of Angel? Huh? No, should they prepare CFS? No, we have to give a very concrete answer here. Not consolidation. Okay, for this, no, you have to understand. See, first of all, yes, answer is yes, because ultimately pharma is controlled by angel. They have got a variable return. In the 45% stake is invested in the equity, and they are taking all the decision. 5 rupees dividend they are proposing. No, that is a return. That is rejected because it is because of the protective rights. If you really want, angel could have repaid money, no? What angel can do? Angel can immediately get its money from somewhere else, repay this loan, finish. Can somebody stop from repaying the loan? If you really want this dividend to get the dividend, repay the loan, no, finish. You can't talk anything more. I am stopped because of one loan, because that loan is a protective right to somebody else, but it is not a substantive right. He cannot stop me from repaying the loan. If that person can stop me from repaying the loan and do all these activities, then I say bank is controlling this pharma. Bank is taking decisions. Understood? Okay, how do we present it to the examiner? So we'll start with the concept of control. When do we say control? Because there is a power, exposure to the variable return, and ability to use the power. Okay, let us see, do we have the power? Yes, you have got a de facto power, because majority people don't attend your AGM, and whoever attend, there is no consensus. Your public participation is very minimal, and those people don't consult also. So ultimately, you have got a de facto control. 45%, you are the majority always. You are the majority minority. Majority minority means among minorities, whoever attend, you are the one who is having majority. So you have got a power. Do you have any dispute in this argument? No. Do you have got exposure to variable return? Yes, because you have invested 45%. And 45% can give you equity dividend. Alternatively, bank might have given a loan, and interest is not fixed. Interest is variable. How much profit you earn, we will decide how much we need to pay. If that is the case, without equity investment, you have got a variable profits. And ability to use, do you have that ability? Yes, by appointing board of directors. However, the bank's rights are only protective. That's why angel has the ability. So angel is controlling pharma. So in Ind AS, angel has to prepare CFS. T Limited is in the business of developing guns with the Indian defense industry. Second question. T Limited acquired 40% stake of K Limited, a company involved in the research of weapons. And T Limited acquired shares in the K Limited to substantiate it, because already you are in the weapon industry. You acquired something called a K. Now K are doing research on atomic bomb or whatever. Nice, no? Imagine a revolver with atomic bullets, something like that. So for this some understanding, you acquired them. Remaining 52% are held by some key management persons of K. Now K consists of 11 people who are all experts in the advanced weapons. Now T Limited has an option to take back 52% at any time by paying 6 times the market price. You remember options? That means you took 48% with an option. The day these 11 people don't listen to you, you can take these shares back, and you can, or at least 2 people's shares you can take. You can make your stake 52% and take all the decisions related to this K Limited. But on purchase of the shares, if you buy shares from any one guy, it is highly probable that all the 11 people will leave this company. So state whether T has got a control over K. I say no. You have got 48%. Can you take any decisions? T has got in K 48%, and other KMP has got 52%. Who is taking decision where we should do research, where we should not do research? KMPs are doing. Now, can you, if they take certain decisions which is against you. You don't want that decision to happen. Can you stop it? Yes. You buy one option. But the moment you buy this option, all these people are going to leave. And the moment they leave, see, understand, it is a research industry. It is a research company. It becomes useless, worthless. That means afterwards, if the research is the relevant activity there. If research itself doesn't happen, then returns are not going to come, no baba. If research happen, it will give you cash. And to do research, you need these 11 people there. So even though you have got an option, that option is useless. So you cannot say that. Even though you have got 52% also, you have to listen to these KMPs with 48%. Still, it's not your subsidiary. So in examination, they will make it 52%. Will you say no? Still nothing. You cannot control that relevant activity. So even though you hold 100%, it is not your subsidiary, because research related decisions you are not taking. Somebody else is taking. And you can't stop them from taking certain decisions. New concept, no? Now, what will be your answer if T Limited has 51%? Okay, I told you, no, 52. Okay. And K Limited can start research and development only with the stringent approval process of the Ministry of the Government. Now same, government can stop you. It's not that if you have got 51, say for example, here we have to forget about KMP. You say yes, we have got the control. But the government is do not protect you here. It is substantive. Government can stop, Baba, don't do research in this weapon. AI weapons, you want to do research. Government say no. That means who is controlling relevant activity here now? Government. In the first case, they were controlling by KMPs. So first you talk about the same story. Even though you have got 52, possibility KMP may leave. That's why there is no control. In the second scenario, you will not be able to use even though you have got 51% because government can stop you. That's why there is no control. You don't have any control in both the scenarios. That means this is not your subsidiary. It is your associate. Why? Because you can influence. But you are the one, whenever you give decision, those 11 people reject it. You remember one board of directors, 4 people were there, 1 person for namesake he was there. It is not even my associate also. Even though I have invested 51%, it is 109 investment. Understood? And we have to give disclosures there. X Limited is holding 100% of the share capital of Y, and Y was treated as a subsidiary by X. Now Y Limited issued convertible preference shares to Z. God knows somewhere them Z came and you issued convertible preference shares. As per this, Z Limited gets the right to participate in the activities, and Z Limited consent is also necessary to pass any decisions. It's not one person will pass. Now if you want to pass one decision, 2 people have to approve, X and Z. So previously you are doing consolidated balance sheet. Now what you should do? Now also you should do consolidated balance sheet, but previously your accounting was done as per 110. Now you have to do accounting as per in joint arrangement, joint venture, because it is Y Limited. So Ind AS 28 comes into picture, because now it turned into a joint control. Previously you are controlling it. So determine whether X Limited should consolidate balance sheet. Yes. Hence Y Limited is a jointly controlled. Further you need to analyze, is it structured with a separate vehicle? What is the legal form, rights to obligation? Because it can be a joint arrangement also, no? Sorry, joint operation also. It can be joint operation also. If it is a joint operation, then 111 comes into picture there. So we can assume it is a joint venture, and because of, see, your investment got shifted from subsidiary to joint venture because of this convertible debenture. So you have to do loss of control accounting, which I'll teach you at the end. Because in control accounting 103, you prepared goodwill. You did 100% consolidation, no? Like this, you should de-recognize the assets and liabilities. 100% of the equity shares to be remeasured, whatever you are holding now. And the difference will be treated to the P&L account. You remember associate we de-recognized, some portion we remeasured, difference we took to P&L, same thing we need to follow. And going forward, you may have to follow equity method of accounting, and the difference will be treated as a net identifiable asset shall be goodwill or the capital asset, the fair value of the investment. But this goodwill will be subsumed in the value of the investment. You don't recognize separately as a goodwill. Solar Limited has 80% investment in the subsidiary. Solar Limited hold 25% in Venus. No, sorry, Mars Limited, wait. Solar has got in a 80% interest in the Mars. Okay, done. Mars, Solar Limited holds a direct interest of 25% in Venus. Okay, that means you have got one subsidiary, one associate. Understood, no? Now, Mars also holds 30% interest in Venus. Now, together, this becomes your subsidiary at CFS level, because through chain holding. Now, the decisions concerning relevant activities require simple majority of the votes. Like Venus, you have to take a majority. Now, who will listen? Solar will tell the Mars directors, no, go and pass this resolution. So ultimately, who is controlling Venus? Solar will control. How should Solar Limited account investment in Venus Limited in its CFS? This is like a chain holding. What they need to do, see, are you holding 100% of Mars, but you are doing 100% consolidation of Venus? That's why there is one adjustment, only one adjustment in chain holding. I am telling you, no difference at all. That means when you consolidate, 80% of this 30% only you take, and that 20% of this 30%, this Mars NCI, you will show it separate. That's the answer here. So you have to say that Solar Limited is going to control because of the voting rights with the combined voting rights, because totally together they have got 55% voting rights. All the decisions of the will taken with the simple majority. So we say that Solar is controlling Venus. Are you okay with this? Solar is controlling Venus. Do you have any doubts? No. Now, how do you account the interest? Although Solar controls the Venus, the entitlement of the subsidiaries economic benefits are determined based on the actual interest. So, for the purpose of accounting, how much is your share? It is 49%, which is 25% direct holding plus 80% of 30% is what you get finally. And as 51% of the P&L OCI net assets shall be attributed to NCI, 6% you will give here, 45% you give here. When you talk about NCI, through chain holding, how much you will take your interest? It is 25% direct interest plus 80% of 30%. This is what we are going to learn. But that is for accounting purpose. For decision purpose, 50% is crossed, no. But for when you account it, your stake is only 49%, only for accounting. But you will consolidate because you are actually taking decisions there. Understand, both things are different. Accounting is different. Who takes the decision in reality is different. That's what you have seen in reverse acquisition also. For accounting, for taking decisions, 55%. With this, we said Venus is controlled by Solar. But when it comes to accounting, you cannot account 55%, no. Because 50% you are not holding. So, you will account only 49%. And balance 51% belongs to NCI. Now, which NCI? There are two breakup. One called a direct NCI. In this Venus, if 49% comes to me, 51% NCI, no? Which NCI? 45% of Venus NCI plus 20% of 80%, which is, no, sorry, 20% of 30%, this, which is 6, will go to your step NCI. Because it is not step NCI, chain NCI. Okay, just one flavor how the chain accounting is going to happen. But I am telling you, it is damn easy. 2-3 times it has come in the examination. Straight away, without like a machine gun, you should do it because there is only one adjustment involved there. Are you clear about this concept? Yes, with this we are done with the concept of a control, and I hope you must have understood in reality how it works. Forget about examination question. You must have got a feel what we do in reality. Yes, now exemption. Scenario A, following is the structure. X is there, A is there holding 100% B and C. X is a listed entity and prepares CFS. Company A is an unlisted entity and it is not in the process of listing also, and company X does not object to A preparing CFS. Whether company A can take exemption from CFS? Yes, because all the 4 conditions will fulfill. Now let us go to scenario B. In the first scenario, yes, you can take. In scenario B, assume the same fact. Company X is a foreign entity and is listed in the stock exchange of a foreign country, and it prepares the financial statement as per US GAAP. Will your answer be different? If X is not preparing as per Indian GAAP, now then you may have to prepare here. The third scenario, everything is same except 100% of the investment in A is held by Mr. X, not a yeah, and then A has to prepare. So in the first scenario, you write all the 3 conditions and say you are not required to prepare. In this case, CFS of the parent are not prepared as per Ind AS. You are preparing as per US GAAP and you are filing where? In USA. Is it available to Indian shareholders? No, that's why you cannot avail the exemption. In the case, the parent will never prepare. So you have to prepare the CFS. Following is the structure of group. Company A is a listed entity and prepare the CFS, scenario A, and they are not in the process of listing, etc. 60% of the equity share capital of C is held by company A here, and balance 40 is held by outside investors. Company A does not object to C to prepare CFS. Now question is, can this C take an exemption from CFS? Yes, provided other 40% say okay, don't prepare. Because it is not your 100%, no. And question for preparing CFS doesn't come to B because B doesn't have any subsidiary. Now whether company C is required to prepare CFS? No, provided 40% NCI will say don't prepare. Other conditions are already fulfilled. Assume the same fact except 40% of the equity share capital is held by company B now. Oh, now who is that 40% NCI? Another subsidiary of A. Now, permission not required because but these people will definitely accept, no, because this B is going to tell B, don't tell that C, don't not to prepare. So you need only one person's permission called A Limited now. Previously you need 2 people permissions if NCAs were independent, and you have to document it. So in the scenario A, since you are partly owned, 40% of NCI should not object. Since you are 100% held directly or indirectly, you are not required to inform B also. Straight away you can avail the exemption. Yes, please. Whether the structure is permitted. It is 2 layers. I will talk about the 2 layers of investment later. Okay, it's not a 2 layer. 2 layer means something goes like this. A has invested in B. B has invested in, say, P, and P has invested in S. Now, okay, S. This is called second layer. This is not permitted. This is first subsidiary, this is second subsidiary. More than second subsidiary you cannot go. But this is permitted. Why? Because the first layer is 100%, that is considered as 0. Then this is first subsidiary, this is second. After this, not permitted. Which one? C is, no, that can be. Second layer 100% comes, you ignore it. But if the first layer goes 100%, you can ignore it as a 0 level. From there, you can have 2 more subsidiaries. But if the first layer, no, you understood that second layer? Yes. Academic. So you are clear about this question. Yes, now you see one more question. An asset manager has set up an investment fund for the acquiring capital contribution from the various investors. So this is one fund. It is getting money from various investors. Okay. Now investing those contributions in the equity share capital of, and this company invest in different MRPL, SBI for the purpose of capital appreciation. Is this investment entity? Now, along with that, they do one more activity. They give strategic advice to their investees. They give, apart from the investment in entities, investment fund also provides investees the strategic advisory services, so they can get a better, that means they tell their investees, do this, do that, okay, don't do like this, so that your profits are more. The moment profits are more, your investment returns are more. So you are doing that strategic advisors to increase your capital appreciation. So you must have appointed Boston Consulting Group. Nice, no? And imagine if I am consulted by Boston Consulting Group and they advise me how to improve my coaching business. Will I not take that advice? Because for one advice I have to pay 2 crore rupees otherwise. So if the companies get free of cost that advices, and why these advices are given free of cost? Because you take better decision, your investments will improve. In turn, my investments will give better return. Nobody will do anything free of cost here. Now it also proposes his investees, it also provides his investee financial support also in the form of loans also. If you want loan, I'll give you loan also. Because I'm your owner already. Some emergency, you take loan from me instead of from bank. Because I'm an investment fund, no. I can do anything. Now it does not hold any investment more than 5 years. Investment fund measures and evaluates on the fair value basis whether the investment fund is an investment entity now with this activity. Otherwise you would have told me, yes sir, it is an investment. Now tell me with this activity. Okay, so for this you have to say 3 elements, like have you obtained funds from more than one investors? Yes. Do you measure your fair value basis? Yes. Yes, you have fulfilled. So now we will go into the one more typical entity characteristics. Do you have got one more than one investment? Yes, one investor. Are they unrelated? Investment funds are done? Yes. And your objective is to earn capital appreciation. Now why you are giving these strategic advisory services? To earn better capital appreciation. Not your, it is not your business as such. Otherwise, somebody may be disguised as an investment entity, but in reality, they are doing this job, consultancy job. And to avoid this consolidation, they are telling I'm an investment entity. So you have to apply judgment whether this represents. Now, question comes: which is the activity which is done on a highest level? This one you are doing or this one you are doing? If 80% of the time you are doing this, then you are not an investment entity. You are a consulting company. So if the fund concludes that it is not substantial, yes, then you can treat yourself as an investment entity, because if you treat yourself as an investment entity, you get a lot of exemptions. Are you clear? Yes, one question somewhere hiding in the illustration 20. Very nice question. Test your knowledge is there. Gamma is a parent company in retail activity. They hold investment in G and D. Gamma hold 100% in G and D. G and hold 60 and 40 in GD. Now, Delta is 100% subsidiary of GD. Did we breach 2 layers? No, because my first layer is 100%. For whom it is subsidiary? G it is subsidiary. So this is first layer, this is second layer. Delta cannot have any more subsidiaries. Followed, no? If I was holding only 80%, then GD cannot have any more subsidiary. Because this is my first level, this is my second level. Okay, that's not, see, we are not going to talk anything about layers, no questions are there. Now, firstly, the Gamma wants you to suggest whether GD Limited can take exemption from preparation of CFS. Yeah, gamma limited, no? So we can say, yes, gamma is there and you not listed, you are not process of listing also. Everybody said gamma is going to prepare the CFS, you can do it. Secondly, if all the facts are same, instead of gamma we have got Mr. X. No, GD can never ever take that exemption because your ultimate parent will never prepare CFS, no? No, ultimate parent has to prepare. Maybe, okay, we'll see. Yeah, that you can do, that you have to do. Yeah, that because your G limited has to prepare. So first of all, you will tell all those four conditions. You can be wholly subsidiary or partly subsidiary. That should not be there. And ultimate parent or intermediary parent. Yes, your answer is correct because G is an intermediary parent. D is an NCI or ultimate parent. Gamma is ultimate parent here. G is an intermediate parent. So anyone should prepare CFS above you. In the first case, GD is not required to inform D NCI because ultimately gamma is the 100%. So G may take an exemption. Clear, no? Because ultimately gamma controls, no? So why you have to take permission of D? But in the second case, you have to, since ultimate parent is X, they don't prepare. G has to prepare CFS and you have to take permission of D limited. Should be informed. If these people reject, then GD has to do. G limited cannot take any exemption only here. Why? Because there is nobody else on its top to claim any exemption. Here G also can take an exemption. Why? Because gamma prepares. So what gamma will do, no? To avoid audit cost and other things, they see ultimately gamma has to prepare. Who is interested? People are interested in G CFS or gamma CFS? Gamma CFS. So why unnecessarily these two people have to prepare CFS? What I will do, I will take the SFS and apply chain holding consolidation. I will take their individual standalone, no, and do the consolidation, finish. Why I do need their CFS again? Waste of time, waste of energy, waste of resources. But if your intermediate parent is listed, it is not waste of resource. That's why there is no exemption for them. Parent is a listed entity. You cannot claim that, no. You have to prepare it. So if you are unlisted, then if your parent is prepare CFS, you need not prepare. Have you understood the logic behind why they give this exemption? Yeah, good. Yes. Next aspect. So first part we have understood what is control, when we can take an exemption, all these things we have understood. Next we will learn about the consolidation procedures of the subsidiary. So when the consolidation is going to start, from the day you obtain the control, and when you will stop, the day you lose the control. The day you obtain the control is nothing but 103. And we have already done opening consolidated balance sheet. The day itself we prepared one opening balance sheet. And that is my starting point for 110. So how the consolidation is going to happen? It's called line by line consolidation of the balance sheet. 100% items, like you have done that. No, PP of theirs, you added to PP of yours. Their investment, your investment. In bracket we have done, no? We added both the things, then and there itself. Did you club their investment with my PP? No. Their investment with your investments. Their current assets with your current assets. However, values of the assets and liabilities are subject to fair value adjustments. What you add in CFS is the fair value of the subsidiary, not your book value of the subsidiary. So first time I don't have any problem because in every question they would have told me what is the fair value of the assets. But the problem is subsequently they will give me the balance sheet of two subsidiaries. So I have to consolidate now. But in that process, fair value adjustments I have to keep in mind. So in any question, when they give you two balance sheet, very first job what you need to do is, on the date of acquisition, whenever it is yesterday or 5 years back, whether there is a difference between book value and the fair value. No subsidiary. In any examination question, that's what you need to check. If no, you should say good. Abba bachao. If Because see, first time consolidation it's child's play for you now. But we are talking about subsequent consolidation. It can so happen. Generally, 90%, 99% of the questions is acquisition happened on 1st April, consolidation you have to do on 31st March, last. But there are questions when they will ask you acquisition happened 2 years back and prepare consolidation statement now. That means first year consolidation they will not ask you. They will ask you second year consolidation. They will not give you because you need a consolidated balance sheet. No, because if you have to prepare consolidated balance sheet now, you need opening consolidated balance sheet. So there is something like imaginative thing. I will tell you, don't worry. It should be very clean to you. Even P&L also you should do consolidation line by line, but again with reference to their fair values, not book values. For example, when you charge depreciation, see, understand students, it goes like this. You have got subsidiaries P&L account where you charge depreciation based on the book value of the subsidiary. You have got this is a subsidiary. This is called a parent where you have got a depreciation. See, parents, I don't have any headache on it. Parent is whatever it is just parent. When you prepare CFS, you take depreciation of parent at its book value, whatever is straight away appearing. But when you take depreciation of S, you take whatever is there in the book value plus adjustment for that additional fair value depreciation. Do you remember, have we done this something in Ind AS 28? We have taken no additional depreciation on the fair value adjustment or something like that. We have to do it here. Elimination of investment in the subsidiary. So entire, see, in your standalone financial statement, there is one item called investment. This will go off now. This is replaced by the net assets of the subsidiary. Going forward in CFS, you cannot tell investments. See, in your parents' SFS, there is one item called investment in subsidiary accounted as per 27. Standalone financial statement of the parent, you have got investment in subsidiary. And you must have accounted as per Ind AS 27. Name only, big Ind AS 27. What is that? Cost or 109. That means there is one item called investment, only one line item. But when you consolidate, the standard says that you eliminate that investment. It is meaningless to tell at the CFS level, I have invested in my subsidiary. And instead of that investment, you take the net assets of the subsidiary one by one, line by line. Now, closing balance of goodwill has to become, because when you calculated goodwill, it was on the date of acquisition. Did you impair that? Maybe you may have to impair if impairment is there. That's why, what is my closing goodwill? It is opening goodwill plus or minus measurement period adjustments for 1 year. Because retrospectively you have to adjust the goodwill. You had some information, there was a condition, you didn't have the information. Minus impairment. Now this impairment, to impair, question comes, did you value this goodwill under full goodwill method or partial goodwill method? Because if it is a full goodwill method, this distribution has to happen to two people, parent and NCI. If this is a partial goodwill method, this should go to only parent. Then you have to calculate the closing balance of NCI. What is closing balance of NCI? Whatever opening balance as per Ind AS 103 plus post-acquisition profit and OCI of NCI. That's what I told you. This is very similar to Ind AS 28. Because for them, we are like an associate. Their investment is like an associate. No? So these workings, we may have to do it. So consolidation is very simple. Do one thing, take their items, add it with your items. Something you will not find in their item. See, you take their balance sheet of the subsidiary, take it, add it with your balance sheet. If there is a fair value adjustment, do the adjustment at CFS level because you don't find that in SFS level. There are two items which you will not find in SFS, but it will come in CFS. What all those? Investment will get eliminated. No? It will come in CFS, but it will not in SFS. There are only two items. Sorry? It will come, whatever net assets of subsidiary in SFS will come in CFS, no? But with plus fair value adjustments. Other than that, I am telling you there are two items which is not there only in the SFS, but it will come in CFS. One is NCI, another is goodwill. These are all called the permanent adjustments. It will come, no, whatever is there in their SFS will come in CFS with fair value adjustments. Subsidiaries, see, I will give you subsidiaries balance sheet. Will their balance sheet net assets will come in my parent CFS? Yes. Will it come at a book value or fair value? This is SFS of subsidiary. Will their assets will come with the CFS? Is SFS of subsidiary. It will come, book value will come with the fair value adjustments. See, again, I am telling you, it may look a bit too complicated. I can teach you in a format manner where you know only the format, not the head and tail of it. But if you understand what I am trying to tell you, see, nobody can shake you. This is what I can guarantee. Irrespective of whatever question it is, you will be able to solve it. Because in my step, there are only two steps. Step 1, goodwill. Step 2, OC, other equity. Other equity. That's it. Only 2 steps. With this, you will be able to prepare CFS. Clean. Now, for this certain rules you need to understand, because it's not, it may sound simple, but it is not so simple as such. You have to understand that the investment will go off and goodwill and NCIs are going to come. This is called a permanent adjustment in audit language. In audit also, audit of CFS is there. We call this permanent adjustment. Now there is current adjustments called intra-group transactions. It can happen that the parent has given a loan to subsidiary, parent has sold material, there can be an upstream transaction, downstream transaction. So you have to eliminate all the balances whichever is there at the end of the year. Straight away, close your eyes, don't apply your mind. Intra-group balances has to be eliminated. Intra-group transactions has to be eliminated. Purchase and sales. See, transactions are different from balances. There can be an intra-group transaction, but there may not be any balance at the end of the year. But there cannot be a balance where there is no transaction. Can there be? Yes. Transaction happened last year. I never settled it. It will remain as a balance. No. So there can be any combination. But starting point is a transaction. And transaction will come in my P&L account, or maybe it may come in the balance sheet also. So intra-group transactions and balances has to be eliminated, but sometimes there can be unrealized profits on the inventories, PPs, etc., which is not sold to third party, that you may have to eliminate. And if such inventory is sold to third party, transactions and balances will get eliminated, but unrealized profit elimination doesn't come into picture. Have you understood this? A parent sell to subsidiary. Subsidiary has that inventory, it has not sold to third party. Now we have got an unrealized profit, we have to eliminate. Imagine if that inventory has been sold to third party. Now at the group level, that is realized, but still balances are there. Balances has to be eliminated, but since it is sold to third party, your elimination doesn't come into picture. Okay, I will explain that. I will explain. See, this is my parent's SFS. This is my subsidiary SFS. When you sell something from parent to this is called a downstream transaction. You have got S limited as a debit balance. You have got a P limited as a credit balance. Now there can be two scenarios. You have not sold. You have sold it to third party. When I prepare CFS, S limited and P limited will get cancelled. Now question comes, where is inventory now? When they have not sold. And I will get that inventory in my CFS also, but that inventory is overstated. That's why I will eliminate profit. Imagine this inventory is sold to third party. Balances will remain, no. That's right, I have to eliminate the balances, but there is no inventory only, so there is no question of elimination. I'll give you the example later, huh? But have you understood in principle here? Transaction, like P&L, if you talk about P&L, eliminate transactions also. But what if I have sold last year, but inventory is still lying this year? So elimination of profits also will happen along with the balances. See, when I say balances, it is the balance sheet items. When I say transactions, it is the P&L items. Certain transactions could have happened directly at the balance sheet, like loan taken, repaid during the year. There is no question of elimination only. Why? Because when the loan given, that is not routed through P&L account. And at the end of the year, since the loan is repaid, balance also not remain. Have you understood in total? I will prepare two CFS, huh? One CFS balance sheet, and I will prepare CFS P&L. So when I tell eliminate balances, I am talking about this balance sheet elimination. And I say eliminate transaction, I am talking about P&L transactions. Because in P&L I don't say balance. It will get adjusted. So how we will see that? But these are all the rules you need to keep in mind. Such elimination is required even though you don't hold 100%. See, in Ind AS 28, we eliminated only our portion. But in CFS, we eliminate 100%. We see, in associate, we recognize the profit to the extent of other party. But in CFS, we will not recognize our profit to the extent of NCI. We will not eliminate our share. So that NCA shares we will recognize profit. No. We should eliminate 100%. Understood the difference? In associate, we will eliminate only our share. That means we effectively recognize other parties' share. But in consolidation, we have to eliminate 100%. We cannot say, I will eliminate my portion because I am holding 80%. I will recognize 20% portion of the NCA. Baba, poor people, Baba, NCA. Why you want to recognize their share of profit? In Ind AS 28, we eliminated only parent share only. And we recognize other parties' share. But here, we are supposed to close all 100%. You are not permitted to recognize the profit to the extent of NCI. Telling that, sir, there are some NCI who doesn't belong to me. No, don't do that. Here, the profit will be 100% eliminated. Logic means, see, there you control this organization. When you are an associate, you don't control. So you recognize the profit to the extent of the people who are actually in control of it. That's why here we say that, okay, Baba, NCS are the one who are influencing, no. So don't recognize their share of profits. Because they are only influencers there, or they may not be influencing also. But when you are an influencer and somebody else is controlling it, you recognize to the extent of others' share because they are controlling and you have rightly earned it. Accounting rules followed, no? So, such elimination, unrealized profit can happen because of an upstream transaction or a downstream transaction. See, in upstream transaction, parent is holding inventory. Subsidiary sells to parent. So, where is the profit? Subsidiary's financial statement. In downstream transaction, parent sells to subsidiary. Profit is with the parent, inventory is with the subsidiary. And when you consolidate, inventory is with you only. Doesn't matter where it is lying. Only question comes whether this inventory is sold to third party or not. Because if the inventory is sold to third party, this has effectively moved out of your balance sheet. You are able to imagine, no? Now, let us talk about upstream transaction accounting. When the subsidiary sells the goods to the parent, profit is with the SFS of the subsidiary, inventory is in the SFS of the parent. So, on elimination of unrealized profit, because we decided to eliminate 100% of the profit, not your share, You pass one accounting entry, parent's share of unrealized profit, NCI share of unrealized profit, because when the subsidiary made a profit, did you give share of profit to NCI? See, during the year, you made a profit, no, your subsidiary made a profit. Did you give one share of profit to NCI? But this has two elements, no, realized profit, unrealized profit. So from the subsidiary's P&L, you gave the share of profit to NCI. So there is one element of unrealized profit. Eliminate this. How? Because when you allocate, what accounting entry you pass when you give share of profit to NCI? What entry you pass for share of profit to NCI? Share of profit account debit to NCI, because you have to credit NCI. NCI should be credited. That's why when you eliminate unrealized profit, NCI has to be debited and inventory has to be credited. If you go and see Ind AS 20A, it is the same entry you are passing, except it is your share. It will go to inventory only because you are holding inventory there. When it is a downstream transaction, when the parent sells to the goods to the subsidiary, profit is with the SFS of the parent, inventory with the SFS of the subsidiary. Since you have got your share of profit, you only eliminate 100%, your only, you never allocated to NCI. Credit to inventory. Why? Because at a CFS level, inventory is there, no. There in Ind AS 28, you credit to investment. Because you don't recognize inventory of them. Because where is inventory now? SFS of the subsidiary. Now when you consolidate, will you take their inventory and add to your inventory? But their inventory is overstated, no? With the profits. Their inventory is overstated with the profits, no? But that is the unrealized profit. So remove that portion from them. Are you clear about this entry? Students, I am telling you, explaining everything with the journal entries. If no, then you please challenge me, you ask me. It is not a, I say it's a crime to explain accounts without journal entries. You have to understand accounts with the journal entries. Anything you ask me in terms of journal entries, simple. Because things should be very clear to you. Are you very clear? But you should add some imagination, because here SFS comes, CFS comes, where from CFS to SFS comes. That you have to imagine here. Otherwise for me it takes more time to explain that. Are you okay? Now we will talk about the fair value adjustments. Don't worry, I will give you more examples, we will solve more problems. Inventory acquired on a fair value on business combination. See, this is different from unrealized profit. Now, you remember this in 103, we did one reverse acquisition. In that one question, inventory was fair valued, have you seen? Now what happens now? In SFS of the parent subsidiary, inventory book value is 100. You take over that inventory at a fair value of 150. This is called the inventory acquired at a fair value, but this is not unrealized profit, no. Understood? This is the difference. Unrealized profit concept comes only in upstream and a downstream transaction after business combination. So there can be a situation when the inventory, because how do you value inventory? Cost or NRV, whichever is low. So subsidiary must have valued the inventory at the cost. And when you take over and prepare CFS, you will take over at a fair value. That's unrealized, exactly. Exactly. Now there is one catch. Okay. Read this and tell me, have you understood? Because yeah, your observation is very correct. That is an unrealized value. Which is going to realize? Who is going to realize this? Who is having inventory? Who is subsidiary is having inventory. So tomorrow when he sell, at what value he will sell? 150. But that differential 50 I have already recognized and sitting in my goodwill. Then one more thing is going to come. I have to make an adjustment. As a double counting, no? At the business combination also I have taken this 50 and loaded it on the goodwill. Next year when the subsidiary realizes it, I will take my share of profits. 2 times counting, same 50 rupees. One is at the consolidation time in my goodwill. Second time when the subsidiary sells to third party, at what value they will sell? 150. So will they record profit of 50? Will I take my share of profit? Is it not double counting, same amount, same inventory? It is double, no Baba. Already I have taken at 150 at the CFS level. That's what now we will see how to adjust this at CFS level, because this creates one problem to me. Understand how this is going to get adjusted, and it is not unrealized profit. It is different from this concept. What I am going to speak now is different from upstream and downstream transaction, because upstream downstream transaction happens after 103 business combination happens, and this fair value adjustment happens on 103 adjustment, because you are going to see both the things in your examination questions. Don't get confused there. Now, in case of fair value of the inventory acquired on the date of acquisition, which is more than the book value, the increase in the inventory value is not considered as an unrealized profit. It's a fair value adjustment. Now, on sale of inventory to the third party, the fair value difference will be reduced from the closing inventory and allocated to the parent and NCI. Now, why? I will explain you with the number, not here in my PPT when that time comes. Followed, no? And if not sold, increase in the closing stock by increasing the fair value difference. Like if you have sold this, okay, book value was how much? 100. Fair value was how much? 150. So this differential 50 you took. Did you distribute it to parent and NCI? Because when you did the NCI valuation, is this 50 considered for NCI valuation in 103? Proportional net asset method? You have taken it. Next year, what you did? You sold it to the third party. You made a profit. Did you distribute this profit to you and NCI? Yes. That's why when you sell this inventory to third party, whatever the differential 50 was there, you should reduce from the closing inventory, because in your CFS, inventory is loaded with 150. But what actually goes out was 100 in the SFS. So you should credit to inventory 50 and debit it to parent and NCI. Where sale takes place at SFS level, no? SFS level sales takes place with 150 with the subsidiary, and in their opening stock is 100. Sales is 150. So they record 50 rupees profit, which I will take at the end of the year and distribute to NCI and parent. But already this is distributed, no? That's why I'll reverse that. Anyhow, I will reverse it CFS level with this entry. Anyhow, this is just an introduction. I will show you with the number so that you are very clear, and in the examination question, how to answer that, what adjustment need to be done, we need to do. At this point of time, I want to in principle discuss with you and get that clarity, like what exactly we are doing. So fair value adjustment for inventory, if it is unsold, you just increase the closing value of the inventory, because if it is unsold, at the end of the year, in SFS of subsidiary, what is the inventory value? 100. So when you have to take, add 50 to it. And the second leg of 50 is already sitting in the goodwill. How? I will explain that. If not sold, no accounting entry, just add it to the value of inventory. Other leg, see Baba, at this point of time, I cannot pinpoint and show you the other leg. I will come to you when I solve the problem. At this point of time, I cannot tell you what is my journal entry for this. Why? Because it's not single entry. It's one big entry there. But with journal entry, I'll explain. And you remember this. At that time, if I don't explain, no, you ask me. Now in CFS 150. Because see, Because when you take over, you have got opening CFS. You take only goodwill value and NCI value from this, not the opening inventory value from the opening. Because inventory might have moved, no, up and down must have happened. So many up and downs are happened. So you cannot take opening inventory value. Impossible, meaningless. It's totally meaningless. Okay, only from the opening CFS you will take goodwill and NCI. Other items you can't take from the opening CFS. Why? Because so many ups and downs would have happened there. That's why what you do, you just take the closing balance from the closing subsidiaries SFS. And because 50 is not adjusted there, add 50 to it. Now, how this operates, I will explain you with the journal entry. Not now, because it is one single entry. In fact, why I should tell you, only should tell me. Not now. Followed, no? So, if it is increase in the closing stock unsold, you have to just add it. Second leg is already there in the goodwill. And if it is sold to third party, you have to reduce from the inventory and you have to allocate it to parent and NCI. Now, what if the PP is sold? Inventory, fine. It can be possible. No, one building is sold by a subsidiary to the parent. Not parent. PP you have acquired. The book value of the building was 100 because a subsidiary is showing at the cost as per Ind AS 16. But when I take over, I may take over at a fair value of 150. No? Now, additional depreciation should come now, and that depreciation should reduce PP and allocate to parent and NCI. Because it is a depreciation entry at the CFS level on the fair value difference. Yes. Decrease means my depreciation also will get reduced, no? No, where there? No, that is generally not possible, because if your fair value is less than the cost, in your SFS you would have valued at cost only, no? You would have taken that hit there, cost or NRV. Whichever is lower, that's why you would have recognized at NRV only, at fair value only. In SFS, okay, the cost is 100. Instead of fair value 150, if I say if my fair value is 80, what subsidiary would have done? 80, then I will recognize at 80 only. So my CFS value and SFS value is not different. That's what I'm telling you. Any question, first thing you see whether SFS value on 103 and the book value is same or not. If same, see good. If no, all these adjustments you have to make. Are you clear? And at the end, I'll give you a format just like 103 format. Just in any question, just to see whether those items are there. But it is, see, understanding only format is a procedural one. Something they give you, some creditor comes. You should be in a position to think why that I added that. What should be, why it should be distributed. Why upstream is only distributed, not the downstream. That logic you should be knowing. Followed, no? Downstream will go only to parent, but upstream will go to both the people. So that logic I have explained you in the form of journal entry. So if any deferred tax is created, you must have created, no? Between this 100 and 150, you must have created a deferred tax also. Now, the moment you start charging depreciation difference, the deferred tax also will get reversed. So, deferred tax asset is created, liability is created. See, that deferred tax liability neither exists in the SFS of both the people. It will appear only in the CFS. Now, when the depreciation, additional depreciation you charge only in CFS, then that deferred tax also you should pass a reversal entry there to the extent of depreciation. Have we done this? Depreciation reversal, deferred tax changes. In Ind AS 12 we have done that, no? Same thing comes here. So I'm telling you, it's a specialization. So many things are there. But don't worry. Only 2 steps, I'm reminding you. So account of depreciation, fair value difference. Yes, these are the 2 major adjustments which you may have to do in the CFS. Otherwise, fairly CFS is simple. It's more like a procedure. Once you understand, you can do it very quickly. But URP and the fair value adjustments are the biggest adjustments you can come across in real life. But in examination, hardly 1 or 2 things they will give you. Don't worry. Now, what about the difference in reporting date? Theory. It says that Your reporting rate can be different. It can, generally it is same. If you are an Indian subsidiary of a parent, both are same. But what if you are a US subsidiary? In USA, you close your books on 31st December. In India, we close it on 1st of March, April. Why? Have you ever questioned? Simply, is there a logic? Or just like it happened on 1st April, Act came, so we started. Why we have to close on 31st March? See students, okay, there is one thought process, one, what is that called, idea. There are two types of countries in the world called developed countries and developing countries. Now, developed countries generally have 31st December as their closing date. Now, by 31st December, profits, they close the books and they start developing they generate the profits and all. Invest, they declare the dividend, AGM is going to happen. So, this process will typically take 3 months. So, by the 3 months time, dividend is declared. So, somewhere 1st of April or in the month of April to May period, the developed country investors have got so much cash in their hand. Now, Indian companies, which is under a group of developing country, start finalizing their books of accounts. Somewhere in this period, they come out with the results, audited results. And if you have made a fantastic profit, the US investor will start investing in India and a lot of dollars are going to flow to India. Developed countries don't want dollars. Developing countries want dollars so that we can pay our crude oil bills. For us, dollar is very precious. You want to spend, not permitted. You want to bring, welcome, red carpet. So understood? Why we have got the 1st April? So that when they close their books and their processes are finalized, they have got a dividend. Let that investment come to us. Because if we also close on 31st December only, then when they have got the money, where they will invest? Because our information will become outdated and maybe we'll, sorry? See, middle of the year, but investors will look for profits. Now, how much you perform? See, generally a benchmark is a profit, like for a coaching institute. What is the benchmark? Results. So, people will look when the results come, no. Like that you can ask, in the middle of the year also somebody can join, no. No, results attract. Like this, profits attract. Followed, no? The moment you start making better profits, AFM principle says, oh, this must be a good company. So, let the investment go there. So, there is a big competition among all developed countries. Who is going to attract this money? Followed, no? No, one thought process. So, at least you should know why there is a difference. What is the underlying logic behind it? Otherwise, simply, it is because it's inconvenient for us actually. Having the financial year 31st December would have been a very good thing because new year, new resolution we could have started. We are in a very odd date called 1st April. In SAP also it's a very difficult thing because SAP goes with the fiscal year logic. They define 1 year because it's coming from Germany, developed country. For us it is difficult because our fiscal year means 2012 and half of another portion. You have to interpret it like this. It's very difficult for us to work in the SAP system with this type of April to March year. Okay. Anyhow, some out of the, but interesting, no? Yes, now comes the dividend from subsidiary. See, in a standalone statement, you could have credited dividend to the P&L account or you could have credited to the other equity, it doesn't matter. But in the consolidated, the intra-group dividend is going to get eliminated. The NCI portion of dividend will be deducted from NCI. Exactly the same way, Ind AS 28 we deduct dividend, no? And no elimination of dividend distribution tax. Oh, if the subsidiary has paid a dividend distribution tax on dividend paid to its parent, dividend will get eliminated, but dividend distribution tax will not get eliminated because it is paid to third party outside the group. Clear? We are talking about accounting discipline, which says that, look, what is happening in taxation right now, we are not concerned. If there's one concept, maybe at that time they have designed it. Yes, there was one examination question, but then in the new syllabus they have removed it. The dividend distribution tax related questions are not there. But I'm just telling you one concept. The next is the uniform accounting policy. They say that you have to apply, okay, I think we were here. In USA, you may finalize the books of accounts on 31st December, then we shifted it. It says that, look, okay, it can be, but any case, the difference between the parent's balance sheet and subsidiary balance sheet cannot be more than 3 months. So what you can do, you can take the balance sheet of 31st December, do certain adjustments and prepare a consolidated balance sheet on 31st March. You cannot take half year different, yeah, but generally across the world, these are the only 2 dates available. You have to apply the uniform accounting policy between the parents and this thing, like your subsidiary is following WDU method, parent is following SLM method. Is it okay? Okay, why? Simple, students, it is not accounting policy, it is an accounting estimate. Subsidiary is following FIFO method, I am following weighted average method. Is it possible? Possible for 2 different type of inventories. But the same inventory, you are following FIFO, I am following weighted average, then it will ask for consolidation adjustment. Because your inventory in SFS is valued with the FIFO method, and the same inventory would have been valued at a parent level at a weighted average method. Then convert your FIFO into weighted average and pass one adjustment entry in the CFS only. No adjustment, at least you don't have, it's just theoretical. Accounting policy is your cost and revaluation method. Subsidiary is following revaluation method, I am following cost method of PPE. It's a policy. Accounting estimate means you estimate some figures. Life, FIFO, LIFO, that is the estimated, life is the estimation. Like you have got a policy, like when you do revaluation surplus is there. You have got an impairment, sorry, depreciation you charge going forward. What you do, that extra depreciation because of the revaluation, upward revaluation, you have got an option to adjust it with the revaluation surplus or not to do it. That is an accounting policy. If subsidiary is not doing but parent is doing, that at a consolidation level, you have to check, is there any subsidiary has upgraded to revaluation surplus? Then that much adjustment you have to do at a consolidation level. And you should thank ICA first of all before the God. Maybe okay. So you should thank ICA because there is no practical questions on accounting policy differences. Otherwise, all these adjustments you should have done that. You should have seen how much is their balance sheet on SFS level, what should be as per our group policy, and differential entry you should pass at a CFS level. Okay. Now one more adjustment comes called a goodwill impairment. It all goes with the partial method or the goodwill. So if you have followed a partial method, you have to do something called a grossing up, which I will explain you in Ind AS 36. But whatever it is, if it's a partial method, you have to allocate only to parent with the grossed up value. If it's full goodwill method, there is no concept of grossing up. You have to distribute to parent and NCI. So with this adjustment, I will give you one format to calculate the other equity and NCI together. Somebody will call it CONPL, consolidated P&L. In any question of consolidation, the first step you have to calculate goodwill. Because without goodwill, you will not get this opening NCI and opening goodwill. These are the 2 things you need it from the opening consolidated balance sheet. Any question, damn, doesn't matter what it is, just calculate goodwill first, then come to other equity. In other equity, you just plot the opening balance of NCI, and if you have given post-acquisition profit, you add it. Post-acquisition OCI, you add it. If you have distributed dividend, you deduct it. If dividend distribution tax is there, that also you deduct it. You have to deduct it. You cannot eliminate it because you have paid it on behalf of the NCI. No, it's a loss to you. No. So what accounting entry you pass when you pay dividend distribution tax? Bank credit, debit expense. So give one share of expense to NCI. Oh, you will take that. Huh? Why you should not give to NCI? Because it's a loss to you. On the distributed dividend, if the company pays dividend distribution tax, subsidiary, should the NCI share should not be given to them only, or will you take it? No, not parent I am talking. See, you have got a subsidiary. Subsidiary makes the profit. Subsidiary declares the dividend. That dividend will take two route. One portion parent will get, one portion NCI is going to get. Now, whatever subsidiary paid the dividend, when you paid, did you receive it and sitting in the profit and loss account? So automatically it will get eliminated. Whatever dividend distribution they did, you show it here, and in your P&L it is already sitting. See, this is the dividend of the subsidiary. So it will get eliminated. But dividend distribution tax, when they pay, you take your share, but you will not eliminate it, you will keep it. Similarly, when the dividend is given to the subsidiary, NCI, you deduct it from their share of profits. And this loss of dividend distribution tax also you deduct it. Then there can be a dividend paid by the parent for its shareholders. That is not going to get eliminated. That will come in the other equity only, along with the dividend distribution tax. Dividend received from the subsidiary will be here. This will get automatically knocked off. You have got a debit, here you have got a credit. This is a negative balance, this is a positive balance. And you need not do it. It will automatically get eliminated. We'll see. In the principle, are you clear? Journal entry, don't think now. So, when I have to prepare a other equity, I will start with the opening balance of the reserves of the parent, take profits of the parent, OCA of the parent, whatever dividend distribution they have done, whatever dividend received, everything I will take. Then I will go to the subsidiaries balance sheet, take the post acquisition profits, OCI, etc. Yes, I got one value. Now I will look consolidation adjustments which are not, see, this is coming from SFS of the subsidiary. This set of transactions are coming from the SFS of the parent. Now there are certain things which should come in the CFS only, which will not come in anybody's SFS. Which is that? Fair value adjustment. Like if you have taken over subsidiary at a fair value, should the depreciation not come? That should come. Reversal of deferred tax liability on because of this depreciation. And now you should distribute to both the people there. Because when the fair value uplifts were done, did they not enjoy it? Because NCA got valued at a fair value, no? And unrealized profit from upstream transaction you should distribute to both. But the unrealized profit from downstream transaction you should distribute only to parent. If there is a goodwill impairment from the full goodwill method, distribute to both. Because this goodwill impairment doesn't appear in the SFS. This will come only in the CFS. You remember in the last question, 10%. It is a consolidation goodwill only, because goodwill come. What if it's impaired? What if its value comes down? What entry you pass? Impairment loss account debit to goodwill. Impairment loss, what you will do? If this goodwill is computed using full goodwill method, impairment loss you distribute both to parent and NCI. If you have computed using partial goodwill method, then do grossing up, then impair, and that impairment you have to distribute only to the parent. Anyhow, that grossing up you need not bother. If you had to bother, then I would have taught you that first. It's a concept which, there is one question, it's a part 2 question for you. There is one consolidation question with the grossing up, but I have left it now because it looks so complicated. Then you will ask, sir, what we are doing. You should find consolidation simple. That's my objective. With this total, yes, you are done. You have caught the heart of consolidation chapter. Because this is the balance you will write in the balance sheet. With this, if you have worked out this correctly, your balance sheet should tally. Are you clear? The loss shall be allocated to NCI even though NCI becomes negative. That means even though NCI goes negative balance, no, you should start distributing your subsidiary loss. So before we proceed into chain holding, yes, let us see some theoretical question and we'll start doing the practical questions. Yes. Yes. Okay. with the parent or subsidiary? Parent, simple. No? If parent gives the dividend, what entry you pass? If parent gives the dividend, what entry you pass? Is it an expense? You call retained earnings. That's why it will go straight away in other equity only. It will not come in your P&L account. That's why you debit retained earnings. Dividend distribution tax is also a loss. Dividend distribution tax also you debit to retained earnings. Both are retained earnings. Credit to bank. Okay? Nothing. No subsidiary, no consolidation. Whatever you have done in the SFS of the parent will come here straight away. Now let me talk about the subsidiary's dividend. When subsidiary gives the dividend, what entry subsidiary will pass? Retained earnings account debit, dividend distribution tax, which is also a retained earnings account debit, to bank. Now when they pass this entry, I will pass one corresponding entry in my parent. No? What is the accounting entry I will pass? Bank account debit to retained earnings. Or I may take in my standalone, I could have taken to P&L account. Ultimately, where it will land up? To NCI. Their share I should have give to them. When subsidiary gives the dividend, should I not give their shares to NCI? Sorry? No, sorry, not bank. Sorry, I'm sorry. Because bank I only received, no. I only received. So out of this, the total I will distribute 80%, 20%. So for my 80%, I will pass this accounting entry. For the 20%, what I will do? It will go directly to them. Should I not reduce their balance? That's why I will debit NCI account debit. So that's why in this, when I pay the dividend by the subsidiary, subsidiary would have passed one accounting entry, retained earnings account debit to bank. So when I credit that retained earnings, I will take 80% my share, 20% subsidiary share. Similarly, dividend distribution tax also they would have done retained earnings to bank. I will take my share and I will deduct balance from the subsidiary share. So now my share, this income will get eliminated, but they will not get eliminated because subsidiary would have received it directly. That's why there is no receipt entry passing. I am going to pass here because I didn't receive the subsidiaries receipt. Why should I account it here? That's why only elimination, deduction happens. And where this is given out of profits. No. So that's why I will effectively reduce this profit, because you must have distributed dividend from where? From the profits. If you say last year profits are already sitting in the opening balance of NCI. So ultimately somewhere I have to reduce this dividend. Are you clear? Perfect. Okay, students, how you find? Understood, no? Yeah, when we solve the problem, yes, I want you to open up your mind, think from the journal entry point of view. Again, just see where the values are moving. So ultimately this is my format. This is the heart. Any problem you can solve using this particular format. Every items are not going to come. Hardly very few items, 1 or 2 items will come. That's why consolidation, what they give you for your examination is fairly a simple exercise. Only thing you have to practice and do it faster. Yes. So